Good afternoon. Thank you very much for joining us. This is a re-recording of our presentation a week and a half ago. Where do we go from here? 2021 update on COVID-19 and investments. What has really transpired since last year and how do we move forward here? Just a brief table of contents, an introduction to Schwaben Capital, meet the team, the race of the century. It's been the worst pandemic that we've had for a long time. 2021 is another last year, or are we going to return to normality? How will the US dollar impact your investments? Historic asset performances, how predictable or unpredictable are they? Asset performance during COVID-19 and valuations, as it is Schiller PE ratios versus US interest rates. Equities are historically expensive. How is that explained? And sector performance during COVID-19 and our outlook. Brief introduction to Schwaben. Schwaben was established in 2010 by myself and my founding partner, Martin Häferle, to cater more to more affluent individuals that did not get the proper service from the large financial institutions. It's been really an overcrowded field, primarily driven by commission and fee and higher fee-based services that are not really in the likes of more affluent individuals. We're fundamental-based investors, and we provide investment, wealth management, corporate finance, and advisory to individuals, estate planning, executiveship insurance, and family office services. Myself, I've been in the investment business for over 30 years. I've held investment banking and investment management positions with some of the largest financial institutions, Royal Bank, BMO Nesbitt Burns, and so on and so forth. Martin Häferle is a successful entrepreneur. He's part of a family enterprise globally with offices around the world. Hamza bin Arif, he just joined us last year. He's an accountant and also just recently got his CFA designation, and he's a vice president and associate portfolio manager. The race of the century. COVID-19 has already claimed over 2 million lives. Over 100 million people were infected, and however, over 75 million have been closed. 26 million people are still active, or cases are still active. And at 2% mortality rate, we may unfortunately see another 500,000 people perish over the next 2 months. It's been the worst pandemic over the last 100 years. The Spanish flu over 100 years claimed north of 17 million people, anywhere from 17 to 50 million people. We may not have the same thing with COVID-19. However, I think that's because of better managed social distancing and better hygiene of individuals. So far, about 100 million doses have been administered. That would mean about 50 million people immunized. However, the actual second immunization hasn't been administered to a lot of the individuals yet. Leading vaccine players. There's two American leading vaccine players, BioNTech, Pfizer, and Moderna. And the British one, AstraZeneca, from Oxford. The Russian one, Gamaleya. And 3 Chinese vaccines, Sinovac Biotech, Cancer Biologics, and Sinopharm. The ones that are just about to get approved, 2 new ones from Novavax and Johnson & Johnson, which is the only single dose, the only one of 2 single dose vaccines that we have so far. A lot of them are generally between the 80 to 100% efficacy. Johnson & Johnson, unfortunately, recently came out with theirs, and their efficacy was somewhat lower. Is 2021 another lost year? Full vaccination is likely not to be completed until 2021. US has appeared to peak in our cases 3 or 4 weeks ago when we had over 300,000 cases per day. We're now down to 150,000, which is a drastic decline and a big relief. Unfortunately, we have new variants, and they may cause another spike in cases. The reporting of the cases appears to peak on Thursdays. I think it's a catch-up from the weekend. There are still logistical challenges for administering the vaccines. However, with today's technology and telecommunication, I think those challenges will be overcome in fairly short order. The other challenge is the acceptance of the vaccine by individuals that may not believe that it's a good vaccine or that it may have side effects. I think it's a fear of the unknown, and it will be alleviated by the proof that side effects are likely not that drastic. COVID has taken a terrible toll on the economy and on society. However, it's forced us to move to more teleconferences and to adopt technology more. The overall economy is going to be a forced and accelerated technological revolution. We will be left with more technology, using technology more abundantly, and going forward, I think that will remain with us. Going forward, I think there will be, as the economy is recovering and people can go out shopping again, I think there will be a pent-up demand for goods and services. And I think this will be quite inflationary, which is good for corporate profits. However, business will have to adjust. The US dollar consideration. US dollar is down nearly 12% since the March high of almost 103 points. The Canadian dollar, however, has appreciated from 69 cents to 76 cents since the middle of March. That's a function of oil having appreciated from $20, which it collapsed to after COVID-19, to now today a price of $55 a barrel. The Canadian US dollar is really influenced by oil prices. The US Canadian dollar is joined by the hip, influenced by oil prices with an 87% correlation. The US Canadian dollar exchange rate will have a significant impact on your portfolios if you have a significant exposure to the US. Hence, I think that's quite important to monitor. Historic asset performance, they're unpredictable. What we've done on the right-hand side, you see the shading of the various different asset classes. And on the left-hand side, you see how different asset classes have performed year after year. As you can see, there's no rhyme or reason. It's really very, very sporadic. It's unpredictable. Just to show that diversification is important in the long-term performance of your portfolio. Here we've shown annual asset return comparisons. We've only provided large cap, US large cap bonds, and real estate. The reason being, otherwise it gets too clustered. However, what it shows is US large cap are obviously the most volatile, and real estate appear to be the least volatile. Real estate may be a little bit more volatile than it shows here because we're not measuring it on a daily basis. Since gold has been the best performing asset class during COVID-19, we wanted to show you how gold has really performed to US equities. At times it's moved counter to where the US equities have moved. In other times it has actually moved in tandem with US equities. So there's no real diversification benefit. The key reason for holding gold is because of political uncertainty or a hedge against inflation. Asset performance during COVID-19. How have different asset classes performed? As I've just illustrated in the previous slide, gold has been the best performing asset class, followed by US small and large caps, and the worst have been REITs. REITs have really been depressed because office spaces have been vacated, and there's a lot of empty office towers. Here we have the valuation of equities. It's measured here by the Schiller PE ratio, which is the seasonally adjusted ratio, PE ratio, seasonally inflation adjusted PE ratio. It really adjusts for the cyclicality and for the inflation component in order not to exaggerate the real PE ratio. It's moved from a low of about 6 or 7 in the early mid 1980s to about 35 right now, a drastic increase. What has really driven the Schiller PE so high? Here we have a 10-year bond yield. It's just the inverse. The 10-year bond yield has spiked at over 15% in the early 80s to down to 1.1% today. So hence, we can clearly see there's an inverse relationship between the PE ratio and the 10-year bond yield. Historically, equities are expensive, but because of low interest rates, we can see that also on the Fed funds rate. The other aspect that we can see on here is that when interest rates were practically at zero, equity markets have moved up. And that's what has driven the recent rally. Equity sector performance during COVID-19. Technology and consumer discretionary have been the best. REITs and energy have been the worst. Obviously, energy has been the worst and has underperformed because of the collapse of oil prices earlier last year. Where do we go from here? And where should we invest? Our focus is on healthcare, environmental, social, and governance, technology, consumer discretionary, and lastly, air freight and logistics. I think those 5 sectors are probably going to do well over the next 12 months. Thank you very much. Stay safe and have a good day.